Maybe they lay off a couple of employees or something, but now they're struggling, right? Now they're struggling. They have to work hard for their money. It was easy when the money was free, but the downside to that was there was very little people out there buying. Now suddenly the economy is healthy, we're booming, now we're in a 5-year bull run, but damn, now you got all these customers, but it costs you a lot of money to be in business. Because the shipping container, ships coming from China cost a lot more money. And the 18-wheeler big rigs that leave the shipping yards and travel to your distribution warehouses, they're expensive. And the employees are expensive because the economy is near full employment, and it costs a lot of money to borrow money. So, it's tough everywhere now, so your profits are reduced. But times are good. Okay? And maybe banks feel comfortable lending you money at 4% or more. That's probably prime. So you might be, the prime rate here on the yield on this might be 3.74, but you might have to borrow at prime, which could be 1.25 above that. So you might be paying 5. And mortgages were probably close to 6% at that time. You see what I mean? So that's just the base price, right? So anyways, let's keep looking at this. 2006, 2007. Anybody freaking out yet? What the hell? 30 years up, 20 years up, 10 years up, 7 years up, 5 years up, 2 years up, 3 months up. Wow. Well, this is when I got pretty serious. Yeah, right, Barry? Something's not right. So let me ask you something. When you see a yield curve like this, what is likely to happen as far as profits for companies? If your 3-month money costs the same as 30-year money, does it seem like maybe business moving forward could be vulnerable? Think about that. You need to borrow money essentially overnight, and they're going to charge you the same as a 30-year loan. So I thought when we were discussing it logically, you said, well, a 3-month loan to a AAA company is fairly low risk, so they're not going to pay you very much, right? Because you're not assuming very much risk. You're not really asking for a lot. It seems like free, easy money and everything's good. But what if that money costs the same as a 30-year mortgage? Think about it as a credit card. All right? Yeah, I mean, these guys are in a heap of trouble. Look at that. That's 5%. 5%. For a 3-month bill. Holy crapola. But if they're not lending money, where's the money going? Straight to the stock market. People are opening up E-Trade accounts with their credit card and buying stock, right? This is where people were buying 3 houses. And the government told you there was no inflation. Okay. Moving forward here. What? Oh. What's wrong with this picture? It costs more money to borrow for 3 months than it does for 30 years. A 30-year pays less than a 3-month. Inverted yield curve. So I want you to pay attention here. This is what I told boot campers. First of all, we were discussing it for about a year before we got to this point. And when it got to this point, I said it's going to be over 12 to 18 months. It's going to be over. Back. 12 to 18 months from now, it's all going to collapse. The reason is a company cannot run profitably when it costs that much money just to have the privilege of being in business. You cannot borrow money for 3 months when it costs you more than borrowing money for 30 years. It doesn't even make sense. You understand when we were talking about the logic? Logically, we are looking at a yield curve like this, and the short-term money should be cheap because you need to borrow that. But if you lent somebody money, shouldn't you get, if you lent somebody money for 30 years and you're taking on all that extra risk, shouldn't you get paid more money? And if you're borrowing money just for a very short term, just for cash flow reasons, you have good credit. You just need some cash flow. Shouldn't that be low? So a business needs a low return, and investors need a high return, right? So think about it this way. If you lent somebody money for 30 years, you got paid less than essentially overnight money? That's bullcrap if you're a long-term investor, right? So something is just not healthy when the yield curve is inverted. Something is sick in the economic world. The system is breaking down. Too many people are in stocks, not enough people are in bonds. Irrational exuberance, aka dumb money, somewhere around 2006, started buying stupid stock at high prices on their credit cards. It happened in the dot-com days, it happened back in here. At this time, where I was also listening to news reports about most people that owned a home owned more than one home. The majority of homeowners owned more than one home. I just couldn't believe it. That's not right. The majority of people cannot be real estate investors because the majority of people are not that smart. So essentially they bought high with the attempt of selling higher. Well, that's not sustainable. And if you lived in the San Francisco Bay